Welcome to CrushTheStreet.com's weekly market wrap-up. Let's start in the equity sector, which saw a record session moving yet even higher in the Dow Jones Index, with Thursday's market action closing at 14,329, more than a full percent above its previous record close back in October of 2007. Further adding to the optimism, jobless claims decreased, suggesting a pickup in the labor market's so-called recovery and perhaps fueling speculation that the all-important February jobs report will confirm what the mainstream media has been talking about all this time: the emergence of a new economic renaissance. Could the markets continue higher from here? Certainly. Was I wrong in forecasting that the Dow would never hit, let alone exceed, its all-time high? Absolutely. Does this mean that we should abandon sound financial and economic principles and go all in towards the equities? That's where I will firmly attest to the negative. Last week's events proved how susceptible this bull market could be towards outside fundamentals, and much of the gains are sustained by reflationary policies whose viability in this context remains very much in doubt. But interestingly enough, a fractal analysis of the famous golden arches of McDonald's suggests that we may see several more months of bullish price action before we come to a grinding halt. First of all, what the heck is fractal analysis? Generally speaking, it is a dimensional or geometric-based analysis that is used within several academic fields, with one in particular applying to the Elliott wave theory of technical analysis. What we are looking for are recurring patterns that apply within the context of similar technical and fundamental time periods. For MCD, there are two distinct fractals, here from late 1997 to 2003, and here from late 2008 to today. And if the logic of the fractals were to play out, we could see a sharp decline in both McDonald's stock and the overall economy anywhere from this year or 2014 and lasting until the eve of 2017, when we would theoretically bottom out. If we take a closer look at the first fractal, we can see that right before the price action enters inside the fractal itself, MCD goes into a declining consolidation pattern. The difference between the bottom price at the entrance of the fractal to its highest point is 2.5. Now let's look at the second fractal, which began at the depths of the 2008 financial collapse. As in the first case, the price action enters a declining consolidation phase prior to entering the fractal. Currently, the difference between the bottom price at the fractal entrance and the high is around 2.11. If we assume a difference of 2.5, MCD can potentially reach $115 per share before getting slammed. Ultimately, if the fractals do play out, McDonald's is potentially facing a return to a $25 share price. Now, I know what you're thinking. $25, that's knucking futz. But what you have to consider is that an identical decline occurred percentage-wise 13 years ago. It's not that far removed from where we are now. And you also have to note that the decline occurred when the tech bubble burst. What we could see this year or next is the bursting of unsustainable reflation, and at that point, all bearish bets are on the table. Unfortunately, I only have time to cover the technical portion of this fractal analysis, but I will cover the fundamentals as well in an upcoming article. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.